Hello, guys. Thank you very much for joining in. We're going to be starting out with this chapter, which is the credit decision. This is the first chapter of the credit risk book. Okay, and if you look at the entire credit risk book, the first three chapter, okay, are kind of connected because it gives you the idea of how a bank, when it is taking a decision, okay, what level they are, what are the parameters that they are deciding to take a decision. Okay, and with that series, the first chapter is the credit decision. Okay, and it is not very important for the exam perspective. Generally, I've not seen direct questions coming from this chapter. One or two concepts are related, but what they generally try to do is they try to combine all two three chapters together. They might ask you a question on that can also be a possibility. So from that perspective, you have to just be cautious that, okay, one or two concepts are important. Before the exam, just go through this chapter once or twice so that you know the basic idea or basic structure of the chapter. Now, when we go towards the uh, first module, okay, and also side by side, I'll be running a short PPT, which has some details, which I feel that is something extra. So I'll be running that also wherever possible. Okay. First and the foremost thing, credit risk. Okay. Now, why are we dealing about credit risk? Why are we talking about credit risk? The book itself, credit risk. Okay, bank or any financial institution. Okay, whenever we look at their balance sheet. Okay, they have the asset side and the liability side. Okay, what are the liabilities? Liabilities are the deposits. Okay, it can be fixed deposits. It can be certificate of deposit. Any instrument which gives money to the bank. Okay, so bank is supposed charging on an average 4% of interest on this. That means bank has to pay 4% to deposits, fixed deposits, saving accounts, current account, all of that. Okay, where the bank is getting the money. It can also be bonds. It can also be commercial paper. Okay, that's the liability side. That is a source of income. The money, basically, source, not source of income, sorry, source of money for the bank. And what bank is going to do is bank is going to utilize that money to create assets. Okay, now those assets are created when bank gives loan to companies, to retail customers. Okay, those assets are also created when bank make investments. Okay, investment into stocks, into bonds. Okay, and suppose the bank is earning on an average 7% on this. So ideally, the bank is earning a spread of 3%, which is a spread between the liability side and the asset side. But do we realize the bank is nothing but an entity which is taking money from somebody and utilizing that money to invest or to create assets? Okay, so bank primarily faces a credit risk. Why? Because if the loans become bad, if the investment value goes down, they still have to pay to the deposit holders, fixed deposit, commercial paper holders, or bond holders. So they face a credit risk that wherever we have given the money, it is not coming back. Okay, that's the core risk of bank. Now we're going to be doing a deep dive into it. Okay, now the first section is more about terminology. They're trying to help you understand what is credit and why are we naming it credit risk. Not very important for the exam, but one or two lines are very important. Okay, so if you read the first paragraph, okay, this line is important. Okay, and the last line is very important. And this is very simple because, see, whenever you give loan to your friend or to anybody else, you would always look at the ability of that person, that whether that person will be able to pay back. So primarily you look at two things. Okay, the first is the ability, financial ability, and second is the willingness. Okay, now these two things again is going to come in your chapter again and again, because that's a core of credit risk. Whenever I give loan or any money to anybody, the first thing I'll check is that whether that person is having any financial capability or not, whether that person is working or not, whether that person is generating any income or not. Okay, so that helps me to understand that he has the ability to pay. Okay, second is willingness. Willingness means what is the person's character. Okay, so that for that you will need to understand, or you should know some history about that person. Okay, so when you go to take a loan from a bank will primarily ask for a CIBIL score. That CIBIL score represents what has been your credit history. Okay, so that helps you to understand what is the character and the reputation of that customer while repaying money, right? On the basis of these two things, you basically try to understand what is the likelihood or probability. Okay, what is the likelihood or probability of my customer defaulting? Okay, in level one, In level 1, you must have heard about expected loss. I hope everybody is with me on that. Expected loss. What was the basic formula? PD into LGD. LGD was loss given default into exposure at default. Now, what is this PD? PD is primarily the ability of that person to repay. If we feel that there is a good chance that a person might not repay, the probability of default would go up, right? So when you're assessing, the first thing that you're going to assess is the PD. Second thing you're going to assess is loss given default. Okay, if suppose he defaults, what is the recovery? What is the source of recovery for? Okay, suppose if I take a home loan, okay, the home is a mortgage. That means if I cannot pay my EMIs, my home will be sold. Similarly, if I take a personal loan, I have to give some guarantee, right? So all of these things is created in such a way that bank has an ability to recover the money. Okay, but banks still face a loss. There's a possibility that bank can face a loss because when I'm selling the asset value is very low. Okay, so this is the context of the first paragraph, which is basically the first 2-3 lines I'm not explicitly talked about. It is giving what is credit and all, but the main part is the last part. So read that entire section. Okay, we're moving towards the next side. Okay, now when they have given you some basic definition of credit risk, I'll be explicitly connecting it back to the expected loss formula. Okay, credit risk is basically, the first line is fairly simple, that the borrower was not able to repay the amount. The risk can result from what? First, it can be a straightaway default. Okay, default in the sense the borrower is saying I don't have an ability to pay now. Okay, now generally default and bankruptcy is used side by side, but I'll just give you a brief about what is that. So suppose if I've taken a home loan and I missed one payment, so then bank will term me delinquent or default on my home loan. Okay, after 1 or 2 reminder or after some time, I might again pay back the amount with some penalty. So I might again be back in line. Okay, so default is kind of temporary. Okay, because it's a temporary scenario of not meeting the requirement. But when we say bankruptcy, it's a final stage that the customer or I have declared that I don't have any money to pay you back. In US, companies file Chapter 11. That is a bankruptcy proceeding. They ask for a legal protection. So that is what the process is. Now, when we look at the default on a financial obligation, over here they have used it mixed. Okay, increase in probability. Why this is a problem for me? If I've given money to somebody else, and previously I was expecting that the credit rating is say triple B, now the credit rating has gone to double B or a single B. Now that's a concern for me because when the rating goes down, it essentially means that the probability is going up, probability of default is going up, and I'm worried that my money will not be back. Okay, this is a very core part. So if you can connect it to your PD. Okay, now look at these 2 lines, very important. Okay, now I'll go first towards this point. What they're saying is this is connected to a loss given default. Why loss given default? Because loss given default is nothing but 1 minus recovery rate. So what they're saying is when we gave the loan, we expected that if there is a default, the recovery would be say around 70%. But now because of XYZ factor, the recovery has gone down to 30%. So that's a loss for me. The default does not happen. Okay, but there is still a paper loss because when I calculate expected loss, okay, expected loss is PD into LGD into loss exposure, the LGD has gone up because the recovery has come down. Okay, so a more severe loss than expected due to lower than expected recovery. Okay, so either at the time of default or before it, if the LGD goes up, that's a problem for me. This point now, what they are explicitly highlighting is related to an OTC derivative agreement. Why I'm explicitly talking about it? Because when I give a loan, suppose if I've given a loan to somebody of 100 rupees, so my exposure is 100 rupees at the start. This exposure cannot go above 100. Fairly logical, right? This exposure can go down if the customer is paying me back some money. When the customer pays me EMI, the principal amount comes down. That is where my exposure comes down because the money which I had given to my customer, $100, Now the customer is repaying me that money through EMI. Now my exposure is coming to 90, 85, 80, that way. So in a normal loan agreement, okay, the exposure is maximum at the amount that I've lent. But when we talk about OTC derivative, the exposure can shoot. Okay, in one point in time, I was at loss. In other point in time, you were at loss. So that is where your exposure to the trade might increase faster because the market is changing. Okay, so this is explicitly related to the OTC agreement. Okay, this section is more about service provided or a commitment done. I'll give you an example connected to your FRM level 1. When you enter into a cross currency swap, okay, we had a chapter on swap. In that, there was a cross currency swap also. In a cross currency swap, at the start and at the maturity, you exchange principal amount. In a normal interest rate swap, plain vanilla interest rate swap, you don't. But on a cross currency swap, you do. So what happens is, suppose if I'm into cross currency swap and there is a maturity going on, the maturity is about to come, and I'm supposed to pay 100 million USD, and I'm going to get some 80 million GBP. Okay, I've made the commitment, I've made the payment, but I've not received the 80 million GBP. So that is called a settlement risk. On the day of the settlement, I have fulfilled my obligation, but I've not received the amount or not received the service. That is primarily a settlement risk. There is a celebrated case, Hertz-Stat risk. You guys should read about it. Okay, it is easily available on the internet. Hertz-Stat risk is primarily the settlement risk. So in many cases, settlement risk is also referred to as Hertz-Stat risk. Okay, it is a case that happened with the German bank. So you should read more about it later. Okay, so I'm assuming I'm going slow so that you guys can read the content along with me. Okay, now if we look at this line, cash and carry, and this first two lines, what they're saying, whenever you are into the business of paying anything in cash, there is no credit risk. Logical? Because when you suppose buy anything on cash, if you go to a departmental store and you buy a goods, you pay immediately. So there's no credit risk for the shop owner. But when you take something on credit, that is where your credit risk comes into picture. Okay, so they've just given you a basic definition of that scenario of why exactly there is a credit risk actually there, and they've given you certain examples, okay, of credit risk. So if you look at the first reference, okay, a company performs a service and send bills to the payment of the rendered service. So suppose you went to a car servicing company, the example, he made repairs to your car and he'll send you a bill, but you're not paying the bill, right? So then you have to, suppose you have a time duration that you have to pay in 10 days and all of it, right? So if you do not pay in 10 days, that's a risk for the car dealer. So they've given you that example. And in a lot of businesses, there is a credit period that works. Okay, so if you have, generally you get around 1 to 3 months, depending upon the nature of the business, that you can pay after a certain period of time. If you pay immediately, you get a cash discount. That is also a part of it. So read the first bullet point. The second bullet point, okay, this is similar to the settlement of the transaction part. So you have paid something, okay, the party pays in advance. So in a lot of cases, you pay, companies pay rent in advance, you book a certain service in advance, you pay for the raw material in advance. Okay, so when you pay and you await the goods and services, okay, you face the risk that, okay, there can be a situation that the company or my counterparty or my vendor might not pay me the amount properly. Okay, so for example, a university pays in advance for computer training for its staff and faculty. This is the training over the course of the following year. Okay, so there is, when you paid already and you are expecting the service to be delivered, then there is obviously a credit risk involved into the entire process. Okay, I'm assuming people are reading with me. Okay, trade credit is basically a very specific term related to a business discussion. Okay, a firm selling the product to its, suppose if I'm Hindustan Unilever and I'm giving the product to my wholesaler. Okay, so obviously I will give some time to the wholesaler that you can repay or you can pay the amount after some time. If the product is very big, okay, or a very exclusive product, then definitely the time duration is bigger because it is going to take time to sell that product also. Okay, so that has been highlighted in this section. Okay, read till this part. Read till this section and give me a quick confirmation. Are you guys good till this part or not? Okay, we're going to the next part now. Okay, settlement risk, like I said, hurt start risk. I gave you an example of the cross currency swap. Okay, now primarily you have made your part of the agreement. You have given some money or you have given some service, but you're not getting the money or you're not getting the other part. Okay, you're not getting the other part of the transaction. Yes, that is basically your credit settlement risk. Okay, so if you look at this example, look at the first three lines. Kindly read the first three lines. It gives you an idea. Nataraj sir, answering to your query, the pointers are almost same. They are different examples. They are different example of the risk that you face when you give something on credit. Right, sir? Okay. Now, I'm assuming everybody has seen the first three lines of that paragraph. Okay. So whenever there is a settlement risk, okay, the settlement risk is a part of the broader financial risk that the bank face. Okay, and the reason being the financial obligation has yet to be performed. You have given, suppose you have made your payment, but the other side of the payment is not coming. Like I gave you an example of cross currency swap. I made the payment of 100 million USD, but I'm yet to receive 80 million GBP. Okay, now if you look at this section from here, what they're trying to tell you is that the entire purpose, now you'll be able to connect why they started talking about cash and carry, because in banking there is no cash and carry. There's always a credit that works in. So if you look at this line, it helps you to understand that credit risk is the core risk of the bank. Credit risk is the core risk of the bank. They cannot avoid it. Read that, you read that entire section, but the last four lines are important. Okay, what bank can primarily do is to reduce that risk. How do we do it? So bank will either take collateral. Okay, so if suppose I'm taking a loan, okay, suppose I want to take educational loan. If I go to State Bank of India, if the education loan is above a certain amount, they will ask for a collateral. Okay, in many cases they will ask for a loan guarantor. Okay, your father might have to go and sign that agreement. Okay, the reason they want, these are all mitigants, that if I face a huge risk, I need something to fall back upon. That is a part. The core reason being because bank cannot enter into transaction which is cash and carry. It has to be credit. Okay, so kindly read till this section. Cash and carry is similar to your cash transaction. When I go to a market, subji market, and I buy something, I'm paying cash and I'm getting it. So that's a spot transaction or cash transaction. Okay. Now the credit risk evaluation component, which primarily means whenever I want to uh, assess somebody, okay, how do I assess it? Okay, so there are certain questions which they have identified. There are four primary components. The first one, capacity and willingness to repay the loan. This was the first point that I said, ability and willingness to repay the loan. Okay, so whenever you go to bank to take a loan, okay, obviously they'll be having a lot of questions in their mind. They have tried to frame those questions. What is the financial capacity to pay? Do I have any income? Okay, is there a chances likely that the borrower can fulfill his financial obligation through the maturity of the loan? That means, do we see anything bad happening with a customer, or because there are a lot of factors involved. If suppose there is a COVID, I might lose my job and I might not be able to pay. So what is the what do they feel might happen through the maturity of the loan, and which can impact my ability to pay? Okay, because that is going to increase their risk. That has been also a question in the mind of the bank. Okay. The next could be, are there any outside forces that affect the borrower's capacity and willingness? This is more specific to business, okay, where business are taking loan, and there are certain external factors, like suppose they are not getting approval from government, or their entire ability to pay is dependent upon one particular customer repaying them a certain money, okay, because their product is very niche, something like that. They're launching a new product. If that product is successful, they will be able to pay with the money. So my borrower's ability is dependent on certain factors, okay, and it can be now for a retail customer, it is the salary, okay, but for a business there can be so many different factors which are within the firm and outside the firm. So that is going to impact the ability to repay. Okay, how does business itself affect the borrower's capacity to pay? Okay, that now this paragraph is is saying that whichever business you are into, there are certain uh, characteristics, or there are certain way of doing business. Okay, so because you are in this industry and a industry behaves in a particular way, there is a good chance that you might not have the ability to pay, or it might impact your ability. For example, whenever you sell something, customer get around 6 months to repay you. That's the norm of the industry. Everybody is doing that. So when you sell, you have to follow the same. Okay, so in that case, you'll have to wait for that 6 months. So that increases the chance of default of my customer. Okay, and hence the customer might not be able to pay to the bank. That is one part. If you are into a niche category, now why there is a concern of niche category? Niche category means there is a good chance. See, if it's a standard product, anybody can buy. There would be good amount of liquidity for that product. But if it's a niche product, customized product, obviously the customers will be very few. And if there is any impact in the market, the sale would go down. Okay, so that is the first point, the first four questions. You don't have to remember this, you have to understand what is happening. So ability and willingness, both aspect has to be covered. The next, okay, next point, these now over here, the outside forces that we talked about is more specific to your business. Okay, for example, if I'm into auto ancillary business, and I've set up a factory or something like that, and I'm not getting a raw material. Okay, so that is an outside force which is impacting my business. That would ideally come over here. When we talk about external environment, it is a more macroeconomic part which can impact you. If suppose your business is working on some tax credit which is given by the government, or some other benefits which you're getting from the government, now government is not having any money, okay, because of COVID, they're not collecting enough taxes, so they are not able to pass on those benefits to you as a business, and hence you might have to incur a huge cost. Okay, so a lot of factors. It can be country specific risk. Okay, it can be business climate. If in within your country business environment for a particular product is not ambient. Okay, for example, tobacco. Okay, if there is a stringent government which says that no, I don't want any tobacco product in the country, that's a change in the government rule which is impacting your business. Okay, so all of this will have an impact on your ability to repay to bank. Okay, so a lot of these things are cyclical in nature. That means uh, any industry, basically you'll see that there is a boom for a certain period of time, and there is a recession kind of thing. That means the sales are not very good. Okay, so it goes through a cycle. Like an economy, industry also goes through a cycle. So that is going to impact the ability of yours to pay to the bank. Political risk is very, very common. Okay, for example, you are into some particular business and your assets are frozen by the government because of some political issue, or you certain exports are banned and you cannot do export a particular product because of political situation, and all of these oil crisis. So that is also going to impact your ability to do business. Okay, so that is the external environment which we were talking about. Characteristics of the credit instrument. Now, whenever I am giving loan to somebody, I am basically signing an agreement. Okay, so mark this entire thing as star. You should know these pointers properly. Okay. So whenever I enter into an agreement, I have to make sure that whatever is written in that agreement, whatever points are covered in the agreement are proper. Okay. So for example, the legal risk, the documentation is done properly. That has to be, all the clauses are written in a proper way. There should not be any dispute on the clause, and it should not go to the court. Okay. If all the obligations are clearly specified, who's going to pay what and what is the underlying asset, everything has to be clearly defined. The maturity and the term of the instrument should be clearly defined as per the discussion. Okay. If it is a debt instrument, okay, either it is secured or unsecured. Secured means there is some portion of the company which is below that debt. So if I'm a bondholder, and if it's a secured bond, and the company cannot does not have the ability to pay, I can sell that property or asset which is being attached to that bond, and I can get my money back. That is a secured bond. Unsecured bond, also called as debentures. Okay, there is no backing as such, so the customer has to wait for the company to enter into liquidation, and then only they'll get the money back. In a very simple language, they're asking whether they have any collateral backing or not. Well, if not, if there is a loan guarantor, in a lot of companies, if suppose Tata is having a small firm and they want to raise money from the market, they might have a guarantor which is a Tata bigger company. Okay, so in that case, all of this has to be written down in your agreement. Is a debt subordinated or senior? Senior debt means when the customer is getting uh, liquidated. So the bank, if the bank has given a senior debt, so first bank will be paid. So senior debt holders are paid first, and then the subordinated debt holders. That is the basic structure. It tells you who is going to get the money first. The priority, okay, is highlighted in terms of the debt instrument. So that should also be very clear that when I'm giving you the debt in your capital structure, okay, is it a senior debt or is it a subordinated debt? Subordinated means below the senior. Okay. Bond covenants. There was a chapter in level one, corporate bond. In that, you must have heard about this covenant. Covenant means the terms and condition. Okay. If you add restriction on certain cases, okay, that for example, if I'm giving you a loan, but you cannot give dividend more than 10%, right? So all of these primarily are given with respect to the section or covenant, okay, to make sure that the lender is protected. Okay. In a lot of cases, if I'm giving you a very huge loan, then I might also sit on your board of director. Okay. So all of this is done so that you have better control, and you have an ability to understand whether the borrower can repay the loan or not. Okay. You also give, in a lot of cases, they also provide convertible bonds. Convertible bonds, you must have heard about in level one, which is more specific to bond getting converted into stock. Okay. What is the denominated currency of the obligation, the loan which has been provided? Okay. In many cases, there can be a situation where bank is giving a loan in INR, but they're requesting the money in USD. That can also be an agreement between the lender and the borrower. Are there any contingent risk? Contingent risk is primarily uh, if there is a default. Okay. Do they have any other risk attached to it? So, for example, if I default and the bank has given loan to me and my subsidiaries also. So, if suppose I default and I have given guarantee to other subsidiaries, so there is a contingent risk for the bank that if I default, obviously there is a default of not only me but all of my subsidiaries. There is a good chance that all of my subsidiaries might also default. So, what is the contingent risk? Okay, that the bank has identified, the lender has identified. Okay, so read this entire section. Prashant, answering to your query, see, senior debt, there's no specific example as such. If you go and look at any of the capital structure, okay, of any bank, you'll find a series of bonds, a series of debts. Whichever debt will be paid first, that is nothing but a senior debt. When you write an agreement, you mention that they will have the first right or the first payment. There's no separate name for it. Okay. Kindly read till this section. Sagar, answering to your query, the senior mezzanine, if you go back to securitization logic, okay, senior mezzanine and equity tranche of the securitization, senior is more secure. Why? Because it is getting the amount first. So you can think of it as a senior instrument. Why? Because it is getting the first money. So waterfall structure, that's correct. Moving towards the quality and the adequacy of the risk mitigant. Now there are two important parts, okay? The quality and the adequacy. Adequacy means whatever risk mitigants we have taken, say collateral or credit enhancement or anything, loan guarantor, whether that will cover my exact risk or not. Okay. And when we say quality, quality means when there is a need. Suppose if I have a collateral and I want to sell that collateral because the customer has defaulted and now I have the collateral with me, I want to sell it. You should be able to sell that collateral, right? People should be willing to buy that. So that represents the quality of that asset. Okay. So when we talk about secured lending, okay, secured lending, it generally means that there is some asset available to repay. Okay, if the borrower is in default, then in that case that asset is going to reduce the risk because you have the asset available, you can sell it and reduce your risk. Okay, now kindly read till this point, the first 5-6 lines, somewhat repeat of the level 1. I'm assuming everybody has been able to read that point. It is more or less same thing, that secured lenders have more right protection, right? Now the use of collateral. Okay, now look at this section. Okay, the use of collateral not only mitigates the losses in the event of default, but also lower the probability of default. Why? Because see, in if you look at gold loans, Muthoot Finance, or not only Muthoot Finance, Manapuram Gold. Okay, so a lot of people, they give gold to get money. Okay, now the risk is generally lower from the ability in terms of, if suppose nobody repays, the gold can be sold. But there is a good chance of lowering of probability of default wise also, because a lot of time these golds are traditional golds of the family. So they might be giving it as a mortgage for certain XYZ reason, but they don't want to lose it. So they will come back to get the gold back. They will repay to get the gold back. Okay, so generally what you see is that collateral reduces your losses, but in some cases it also helps you to lower the probability of default. Okay, so what banks also do, when they get the collateral, they will do the analysis of the collateral also. They will see whether the paper of the, if it's a land or a property, the title is clear or not. Okay, they will have their own legal team to check it. If it's a gold or any other asset of high value, they will have an independent team to value that asset so that the risk is reduced. Okay, when they are making that decision, they should know what is the value of that asset and what is the chance of the change in the value. Okay, so if I go and take loan from Manapuram Gold, okay, so I'm giving a gold part and I'm getting money, so there will be a haircut. So they will not give me entire 100% of the gold value today. They will give me only 70% or 75% because they have to keep a buffer. Okay, so that is the part. I'm assuming that everybody is reading that section. Okay, now this line is basically telling you that whatever collateral is available, the lender will primarily try to do their own assessment and would try to identify what is the value of that collateral so that they can connect back to the lending. So if the whether the collateral is able to cover the loan that I've given. So for that, you need to understand the market value of the collateral. Perfect. Few more points which will help you to understand the collateral aspect of it. 3 issues regarding the risk mitigants include: is the collateral pledged or given to any other loan? Suppose if I have a property, okay, and I'm coming to you and telling you that I want loan, take this property as pledged, okay, but I have used the same property for some other loan. Then what will happen if I default? Both the banks or both the lenders will not be able to get control of the property. So whatever assets that you're giving, is it pledged or somewhere else? Okay, so I'll give you a very basic example. Suppose you take a home loan, or primarily you take a, suppose I've taken an educational loan and I've given my home as a mortgage. Okay, then what the lender is going to do is they will send out a letter to the society, and they will say that I have a first lien on that home. Okay, first lien means because I've taken a loan, I've given a loan to the customer, and the customer's house is a first lien because it's a mortgage with me. So if anybody wants to sell that loan, they will have to remove the first lien, and then only the property can be sold. Okay, so that is one example of pledging the collateral. Okay, the estimation of the value of the collateral, not every collateral can be easily valued. Why? Because there might not be an active market available. If it's a shares or bond, you have an active market available. What about real estate? You need a proper process. You need a real estate appraiser to identify the value of the part. Okay, the loan guarantor, this is also credit risk mitigant. When we talk about it, the idea over here is that if the loan guarantor, so now suppose if I'm taking a loan and there is somebody else who's guaranteeing me, my friend, for example. Okay, so bank will obviously assess me, and they will also assess the guarantor, whether the guarantor has ability to pay or not. Okay, yeah, what is the work that guarantor is doing? Again, the same logic, willingness and the ability, everything. So they will do heavy analysis of my friend's ability and willingness to pay, friend's credit worthiness, the guarantor's credit worthiness, because now they're concerned that if I am not able to pay, my friend should be able to pay. Okay, so that is being covered over here, and these things are primarily covered when a parent company, okay, which is a bigger name, gives guarantee for a loan on a subsidiary, like I gave you an example of Tata Group. Okay, so read till this section and give me a quick confirmation on chat. All good? Taking you towards the qualitative and the quantitative technique. Okay, now obviously the quantitative technique you must have heard about a lot. Okay, because every bank, every financial institution which is giving the loan, they would do their own assessment, right? For the financial for the companies, they would do their balance sheet analysis. They will look at what is the business, who all are the management and all, everything. They will do their entire calculation based analysis. But when we talk about qualitative assessment, it is more about gut feeling, or it is more about your understanding about the market. So intuition or gut feeling. Now, why they are talking about it? If you're a bank manager, and if somebody is coming for a loan, very low amount loan, say 5 lakh, 2 lakh, when you talk to that customer to understand the profile of the customer, and bank manager, because he has an experience of so many years, he has been talking to so many people, he should be able to identify whether the customer is good or not. Okay, that is a qualitative assessment. Okay, so quantitative assessment is very, very easy to do it. Okay, you have a set process to identify some numbers and that. But when we talk about the qualitative assessment, it is more about subjective judgment, gut feeling assessment, to see whether the person will be able to repay or not. Okay, and how do we do it? That has been also highlighted. The first is they gather information. Now this is primarily they will, this is the old school method, where what happens is that if I'm in a village and I'm looking out for money, the lender will ask about me to a lot of people and get an idea that whether I repay or not, because historically there was no method to identify my willingness to pay. Okay, but right now when we look at CIBIL score, all of this is kind of gone. Okay, you look at the score, and on the basis of that you come to know what has been my credit history. Okay, right now the lending decision are centralized. Okay, and it is not possible for you to know each and every customer or get the details of the customer. Okay, it is primarily more about some tool that you are using to help you understand whether the customer will repay or not. A lot of these fintech companies who are doing peer-to-peer lending and all, they use your Facebook data, they use your social media data to analyze using AI whether you will repay or not. That is a new trend that is there in the market. Okay, face-to-face meeting. This happens today also. If the customer is taking a huge loan, even a retail customer, They would ask the customer to come to the bank, meet the credit manager. He will have some questions. Why are you taking the money? What is the need? How will you repay? Everything. Okay. They will also ask for a bank statement to show whether you are earning a particular level of income or not. Okay. So face-to-face meeting, like an interview, helps you to understand whether the ability plus the willingness is still there or not. Okay. Name lending is, for example, if Ambani comes and tells the bank that I want 100 crore loans, okay, without any personal guarantee, also bank can give because the name itself is so big, the status, okay, that is also possible. Okay, so name lending generally happens into a business, generally happens in a trade. So, for example, if I'm into business and I want raw material without paying the any upfront payment, because the name is so big, my vendor will give me the money, give me the raw material. Okay, so name lending is generally done for those people where the perceived status of the individual in the business community is very big, or a perceived name of the concerned person in the market is very big. Okay, that is the third point. The fourth point, extrapolating past performance in the future. Now, this is tricky. What they want to do is they will look at your history, and basis that they will try to extrapolating means they will try to anticipate what can happen in the future. So basis the historical pattern, they can identify what has happened in the future. Okay, repaying in the past will give you whether the person will be continuing to repay in the future or not. Okay, so read till this section. Okay, so quantitative research and qualitative research, Sagar, answering to your query. Okay, it is quantitative research and qualitative, it's very different topic. Quantitative research means you're doing the assessment, so you're doing survey, you're doing some calculation, and you have some method or tools. Qualitative means you are more about when you go and talk to people, you get an understanding of what is there. So research in the sense it is related to new product launch or all of this. Yes, extrapolating is just giving an idea to me that okay, by looking at history, future can also be good. It is not, there's no guarantee. Definitely, there is no guarantee. See, by that logic, Ashley, so if a bank is looking at my CIBIL score, does that give a clarity that tomorrow I'll repay my loan? No, right? Tomorrow anything can happen. But what we do is, by looking at a history, we are getting some sense of what can happen in the future. Okay, taking you towards the next part. Now, in this paragraph, what they're trying to tell you is that historically, the willingness, okay, of the borrower, or I said ability and willingness. So ability, obviously, everybody checks, but in terms of willingness, there was no specific tool in the history. So they would rely more on moral obligation of the borrower. Why? Because if tomorrow in the history, or basically in the previous times, if you could not pay back the money, so you'll have a bad name in the community. Okay, so people fear about that, and they would repay the loan because they don't want any bad name, or they have a moral obligation. They think that okay, I've taken a loan, I have to repay. Okay, but when we talk about current system, we know a lot of people who have the ability to pay, but they do not pay because there is no willingness. So Vijay Mallya, for example, or Nirav Modi, they've done so many fraud, but they might have the money also, but they're not paying. So in that case, you need court or a legal system to protect the lender. Okay, so that is been highlighted over here in that paragraph. So kindly read that entire section. taking you towards the next section. Okay, now this paragraph, it is not explicitly needed for you to remember. Okay, you can just look at the first 4 lines and these last 4 lines. Okay, so what they're trying to highlight is that giving you what is the strength of the legal status in a country. Okay, so if in a more developed country, the legal or judiciary is very strong, which means the lender, okay, will have a good amount of right, or he will be protected. If he anything happens, the borrower has to pay the money back. Okay, in a less developed countries, you can pay the money, you can take the money, and you can still run away. There's no problem. There's no impact. Okay, so what happens is that it depends upon what is the legal cost associated with the activity. So if you look at this, creditor must also consider the cost associated with taking legal action against a delinquent borrower. What does that mean? Suppose if in a particular country, if I've given loan and the customer is not repaying me, but entering into a court case is very costly. So I might not enter and I would try to settle it outside the court. Okay. So it also depends upon what is the cost of the legal structure within the country. That is the last 3 lines. Read the first 4 lines and the last 3 lines. The middle part, just a basic understanding of different countries having a different score, okay, which tells me the legal risk of that particular part. So lower the risk, lower the score, greater the legal risk. That means lower the score means the legal system is not strong enough. All good? Okay, let us go towards the next side, the quantitative techniques. We talked about the qualitative techniques. Quantitative techniques, if it's a company and all, we're going to be, the next module is more about quantitative techniques itself. But the idea over here is that you have some historical numbers, okay, of the borrower, and you look at the past, current, and past and the current performance, and you try to understand whether the customer will have the similar ability in the future. Okay, and this is a core. So whenever we do credit analysis, this is the first thing that you will do. Okay, this is the core of the quantitative credit analysis, to identify whether the borrower has a capacity to repay or not. Willingness is very different, very difficult to identify, but capacity you can easily identify by looking at the quantitative analysis. But the problem associated with this approach is highlighted also. The first is historical nature of the data. Suppose if I'm looking at the balance sheet, okay, the balance sheet is being reported on 31st of March, but today we are standing on in the month of October. Then whatever data that I have, it's very far in the history, and that might not give you the current picture. That can lead to miscalculation or misunderstanding of the true risk of the borrower. Okay, so whatever data you might have, if it is historical in nature, very far away from today, then your ability to take decision also gets reduced. Okay, that is a first point. The second point, okay, difficult to make accurate projection, okay, using historical data. In a lot of cases, okay, the information which is available is not straightforward available. Okay, for example, now this is where the AI and all of these systems are being able to get some idea or the pattern of the behavior. Okay, suppose if you're looking at the financial statement, okay, if you look at bank's financial statement, it's going to be very different as compared to manufacturing part. So every different company or different group or different industry will have a different set of financial statements or the balance sheet or income statement. So firm will have to create, the bank will have to create different set of ways to tackle that diversion. Okay, so if you read this point, okay, they tell you the first is obviously the way the data is presented. The second could be accounting rule also, because if some companies are following US GAAP, somebody's following Indian accounting standard, IFRS, obviously there's going to be difference, and difference in terms of terms and difference in terms of calculating things. So that can also have an impact on your ability to understand the capacity of the borrower. So read that first 6 lines, 7 lines. All good? Okay. Next part is that whatever financial statement that we are looking at, we are also assuming that those numbers are accurate. But we have seen historically that a lot of companies, they do fudging of numbers, and those numbers might not represent the true risk or the true nature of the business. Okay. So to understand conclusion over the same data, okay, is slightly difficult, because suppose if I'm looking at the financial statement, I might get a slightly different answer, and somebody else is also looking at the same financial data and might get a some different answer based on the experience, okay, of my experience with that company or my experience with that industry. So there's still some component of subjectivity involved into it, because the data, you might question the ability on the of the accuracy of the data. Okay, so that is being covered in the last 4 lines from here till here. Kindly read the same. The last paragraph over here, what they're trying to say is that definitely quantitative analysis is important for your understanding of the credit risk, but you should also focus on the qualitative analysis. Why? Because obviously this will come over a period of time. The more you are into the business, the more better understanding you get with respect to the customer. Okay, this is more of an art. So judgment, getting a gut feeling is not easy. Okay, but this also helps you to refine your ability. Okay, so it defines your ability to identify which is a good customer, which is a bad customer. Okay, so this last paragraph is more generic in nature. There's no important point as such. Okay, you can read this out. It is only giving you the idea that qualitative assessment should not be ignored. Let us go towards the question. Now, Blackstone Credit Inc. made a loan to a small startup firm. The firm rapidly grew. It appears that Blackstone has made a good credit decision. However, the firm grew too fast and could not sustain the growth. It eventually failed, and Blackstone had initially estimated exposure default as this. Because of the firm's rapid growth, the line of credit ultimately lost a bigger amount. So basically, your exposure has increased. Okay, your exposure has increased. What do you think is the answer for this? Because this is related to your points, which the question that we had talked about, the points related to what can be the impact. So if you look at this example, initially this was this number and this is increased. So your expected exposure has increased. It has become more severe. So if you look at the option, the answer C fits more properly. The answer C fits more properly, and that is what I think so a lot of people have also identified. Let us go to the next question. Now, Brent, a credit analyst with Hometown Bank, is considering the loan application of a small car dealer, is solely owned by Bob Justice for more than 20 years and sell 3 brands. Okay, because the rural location, most of the cars sold in the past by the dealer have been large pickup trucks and sport utility vehicles. Sales have declined, and the gasoline. These are the problems. So what he is thinking, that why don't we sell hybrid car? Okay, and that's the reason he's going to the bank with a request to get the loan. Okay, Justice is borrowed from the hometown bank before, but currently do not have a balance outstanding at the bank. That means there is no line of credit available. Okay, so which of the following statement is not one of the 4 components of the credit analysis? The credit analyst would be evaluating when performing the credit analysis of the potential loan, not the business environment, competition, and economic condition. This is good. This should be looked at, because what is going to happen is, if there are no people who wish to buy hybrid car, or people do not have money to buy hybrid car, then your product is failed, right? So this is used in the analysis. Justice's character and past payment history with the bank. Obviously, this will be checked because he's coming to take a loan. So we are looking at not, okay, not one of the 4 components. Car dealership's balance sheet and income statement for the last few years, as well as Justice financial statement. Hmm. Okay, so this is true. We should be checking, right? We should be checking this, because balance sheet is needed. when performing the analysis. Yes, the financial health of Justice's friend and family. There's nothing mentioned about friends and family who could be called up to guarantee the loan. This is not directly given in the question. So I think so D is the answer, right? Let us go to the next question. I want everybody, all of you to answer this question properly. Okay. Sarah is a newly hired loan officer in the bank, and her boss told her that she's going to have commercial loan to talk to friends and hear about local businessmen with a great reputation. Okay. Everyone in the town says that someone to meet, okay. Impressed with the business sense. They discussed a loan on a new venture Johnson is considering and agrees to the great idea. She takes the loan application back to the bank and convinces the chair of the loan committee, lucky to be able to do business with something. So this is an example of what? So what primarily is happening is the Sarah is not doing any quantitative assessment. That is very simple and straightforward. Extrapolating, see, if you read, there can be a situation, but this is more about qualitative assessment where you have looked at name lending. Yes. So this is the answer, name lending. Historical analysis is not there because there's no quantitative assessment that is being done. So mostly you can get confused between B and B. But if you read the case properly, it is more as a sense of B, the name lending that is happening. Okay. So we are done with the first module. We are moving towards the analysis part now. Now over here, the they are more talking about the quantitative analysis of the section in which they have bifurcated the customer into 4 different categories. There's a table also. Okay. So if you look at the categories, it can be a normal consumer like us. Okay. For example, if I'm coming to take an auto loan or a home loan, so my credit worthiness will also be checked. Okay. It can be corporations. Corporation means, say, Aditya Birla Group, where there is Aditya Birla, suppose manufacturing company, or UB Group or ITC, where these companies are non-financial. Why they have bifurcated financial and non-financial? Because the financial companies are slightly complicated in their balance sheet. If it's a manufacturing firm, service firm, it is slightly easy to analyze. Okay. If business is into very niche area, okay, then definitely the difficulty will increase. So for example, if I'm into airline business, then the risk will be slightly higher. The assessment of the uh, statement will be slightly difficult. So it also depends upon what business you are into. But we are doing a very clear-cut bifurcation between a financial institution and a non-financial institution. Okay, when we talk about financial institution, it is primarily bank. Okay, the major one. NBFCs can also be there. Okay, insurance company because BFSI segment. Okay, investment companies also fall into the same. Government, why government? Because a lot of these big banks, they invest into government bonds. So when they're investing, okay, the bonds can be a state government bond, it can be a municipality bond, it can be government of India bond. So when they're investing into these instruments, they should be clear that what is the sovereign risk involved? What are the chances that the government of India might default or the municipality might default? Okay, non-state entities, okay, non-state entities are primarily it can be government companies specifically, or it can be municipalities also. Okay, everywhere you will look at the assessment of what is the ability of the government to repay. Okay, so kindly read all the 4 pointers, the basic types of borrowers. There's a table in which they have identified or highlighted. Right. So now the basic bifurcation has been identified for all the 4 type of customers. The first thing that we are looking at is the capacity. How do we identify the capacity of a particular customer? Okay, a consumer definitely will look at the wealth, salary, whether I have any cash available, whether I have any gold available, that will be checked. Okay, for corporation, it is more about liquidity. Whatever business you are into, does it give you more cash in hand? Okay, or it has an ability to give you more profit. Okay, then that is the two important points. So you can look at liquidity and profitability. That is the main point. In some cases, they look at capital position also. What is the current capital position to understand whether the company is solvent or not. But the main 2 points are liquidity and profitability. That is for the corporation. When we talk about financial statement, okay, if you look at this section, it is asset quality becomes very important. Okay, whatever lending that we have done historically, whether that lending is good or not. Okay, so that is the main part. That's the reason when you look at any bank, okay, you look at the NPA. Okay, whatever business that they have done in the past, whether those business were proper or not. First, we will check that, and then we'll go towards the liquidity part. Whether the bank is doing a business in such a way that there's a constant liquidity available with the bank. Okay, because if you look at Basel requirement also, they talk about having banks the certain amount of liquidity to maintain that business. When we talk about sovereign, that means country or government and all of it. This is more specific. What is the GDP of the country? What is the debt of that country? Debt as a percentage of GDP. What is an import and export trade? How much tax we are collecting? From what sources the taxes are coming? Okay, so whether there is a social benefit that I have to give as a government. That means whether I have to give free health insurance to people who are above 60, whether I have to give non-unemployment benefit. So all of this is a cost for the government. So that has been covered. This is an entire part. Basically, what they're trying to understand is whatever is a receipt of the government in terms of tax, charges, and how they're spending that. That gives you ability to understand whether they have the capacity to repay the amount or not. Okay, kindly check this entire section. Okay, I'm assuming everybody has been able to go through that content. Right, the paragraph. Next section, willingness. This is very interesting. Why? Because for a retail customer, definitely there is reputation of individual or the payment history. Now, obviously, everything has been boiled down to CIBIL score or FICO score that we look at the customer level. Okay, and this is very easy to analyze because whenever you do the transaction, it hit your CIBIL. Okay, in terms of the companies, the management becomes very important. If you know that the management is fraud, then you will never lend to a particular company, right? That's the reason HDFC never gave any loan to UB Group. So they had a very strict policy in terms of assessing the quality of the management. Okay, so that is the first thing that you will do. We'll have a look at whether the company, whether the people who are running the company, are they good enough or not. Then they will also look at historical debt service. What does that mean? In the history, whatever debt they have taken, okay, whether there been any news against non-repayment. Okay, so we'll look at that also. For a bank, again, the quality of management is important because for a bank or a financial institution, the money is flowing very huge within the company. Okay, so this becomes more important. Okay, the qualitative analysis becomes more important for a bank. Okay, especially people who are heading the company or heading the bank. Okay, so and this also is taken care by RBI because RBI looks at the management who's going to head the bank. So when Aditya Puri is leaving HDFC, who's the new person who's going to come? Because if we do not take care of this now, the HDFC bank might fall. Okay, similarly for Kotak Bank or any other private sector bank. Okay, so RBI do have a say on that. Next is the if you look at a government or a sovereign. Okay, now these section or these they will also look at what is the political impact to it. So if suppose a loan taken by one government and the other government is not interested in repaying that loan, okay, because of the political dispute or anything, that can also be the case. What has been the history of that country in repaying? We'll also look at the legal system or how the enforcement of the legal system is managed. Okay, suppose if I've given a loan to Pakistan of around $5 billion, Okay, if they are not having any ability to pay, there are international arbitration courts in which the matter will go, and we'll have to fight it out. Okay, that is also a section given over here. Kindly read that part. Next section, method of evaluation. Okay, so for an individual, it is going to be credit scoring model. This is more about internal credit scoring model because you don't have external companies assessing an individual. So you generally have your own models in which you have to plug in numbers. A lot of banks have it. Okay, and they look at what is the income, what is the salary. They will do the profiling of the customer. What is the loan that you're taking on your current salary? What is the amount of maximum amount of loan you can take? Okay, if you are a permanent employee, then you will get slightly higher. If you're a temporary employee, so all of this is basically a part of the credit scoring model which the bank uses. Okay, now most of these inputs are manual, where you have a credit team in a bank, and that team is responsible for looking at the profile of the customer, inputting it into some numbers, and identifying whether the lending has to be done or not. They will also be checking at what is the collateral available. In case of a mortgage, okay, loan or a home loan, they will look at what is the value of this home, what is the value of the car. Okay, so that is primarily going to also get checked. Okay, so that is the first section. The next part, okay, is related to your organizations, we call corporations. Okay, now this is very structured. Okay, so it's basically you do a financial statement analysis. You would also look at accounting related points, management discussions. You in a financial statement, you also have management discussion analysis, what they feel about the future of the company, what is the major customer that they have, what is the bifurcation of sale. So you'll do entire analysis. This is time consuming, where you have to give a judgment on the basis of the number of the financial statement whether the company will be able to pay back or not. So for bank and non-financial institution, it's almost the same. Okay, for a country, there is political environment also as an added factor. You will also look at the legal thing and all of it, but most important is the political environment, because if there is a dispute going on between India and China, then it will impact the ability of the country to generate revenue at a certain level, and again it will have impact the ability to repay. Okay, so more subjective analysis has to be done with respect to the political environment, geopolitical environment that is happening currently. Okay, so read this section, the method of evaluation. Subhita, answering to your query, so definitely there can be a scenario that the customer is taking the loan for the first time. Okay, and there is no payment history as such. But in that case, the assessment will be very strong. Okay, so and also it depends upon the loan amount that you are looking at. Suppose if a college fresher is asking for a loan of 1 lakh or 2 lakh, it might not be a very big amount. But if he's asking for a loan of 10 lakh or 15 lakh, that's a bigger amount. So bank will do assessment on the basis of the loan amount also, if there is no prepayment history. So they have an ability to understand whether a particular amount of loan can be given or not. Willingness is very difficult to understand, even if for a retail customer. Okay, like I said, if your CIBIL score is very good, that does not mean you cannot default in a loan. Okay, because default depends upon a lot of factors. So bank is willing to take that risk if the loan amount is smaller, because when they have an entire retail portfolio, it's a diversified portfolio because it's not only one customer who's taking the loan. There are so many customers. Okay, taking you towards the loan size. Okay, so when we talk about the loan size, retail customers generally have a very small loan size. Okay, but if we talk about home loans, okay, then it can be slightly bigger. Okay, and in most cases these are all secured. Okay, most cases, in some case like personal loan, it might be slightly unsecured. Okay, for the retail customer. For companies and banks, definitely if they're going to take loan, that's obviously it's going to be very very big. Okay, and for example, their exposure is very large, and the debt which is taken can be both secured or unsecured depending upon what is the market condition, what is the state of the company, on the basis of which it can be secured or unsecured. Okay, for bank or for government, generally the when government of India issue bonds, okay, it's kind of having a backing of the government that we'll repay. There's no other security as such. But when we talk about municipalities or sub-sovereigns, okay, they might have a collateral or they might have a secured part attached to it. Okay, so kindly read till this section and give me a quick confirmation on chat. All good. So this table, you should read one or twice before the exam. Obviously, there are very basic structure to it. So you might not remember the exact part in everything. Wherever I have highlighted important lines, you should remember that those term at least. Okay. Now this section, they are saying that okay, when we look at financial statement and non-financial statement, there are two major bifurcation to it. So mark this as star. The first is the quality of the asset and financial statement is very important, like the NPA I mentioned. NPA has to be proper, okay, and that will lead to the ability to understand whatever historically they have lended, is it being done properly or not. Okay, cash flow, which means the liquidity, again the 2 points, quality of the asset and the liquidity. These two things are very, very important. Okay, see, having a good amount of liquidity does not mean that you will be able to repay. Why? Because liquidity is there, but it has to be given to somebody. But it gives you some idea that okay, the cash flow is there, okay, and it can help you to get some idea about the credit worthiness. But that's not the leading figure. The leading figure will always be the income that is being generated by the bank. So read these 3 lines. All good. Okay, now look at this last 4 or 5 lines. What they're trying to highlight is that prior to 2007 and 8, the financial statements of the bank were basically not giving the true picture of the risk of the bank. And when the stress period came in, the liquidity squeeze came in, and the bank started crumbling. Okay, so it has become more and more important for the regulators to also focus on the bank's actual financial statement, and hence there has been a lot of change in the Basel rules to identify whether the bank is having a liquidity or not, whether the bank is having ability to repay, whether they are keeping sufficient amount of capital or not. So all of this is being identified post 2007 financial crisis. So read the last 4 lines. So taking you towards the next section now, the quantitative measure. Now this is more specific to the basic credit risk that we are looking at. So this is related to your expected loss. What is the formula for expected loss? PD into LGD into the exposure at default. Okay, PD into LGD became the exposure of default. Okay, so when we look at that, we are trying to identify this as an expected loss. The reason we are looking at, because we want to understand that when we enter into a loan agreement, when I'm lending, what is an average loss that I might feel in that agreement. So what I would try to do is I would try to cover this by asking for a processing fee or some charge from the customer since the start of the contract itself. Okay, so this has been highlighted over here. Okay, so whenever you enter into an agreement, you would obviously look at the ability of the bank, of the customer to repay. Okay, and also that if there is a default, what is the recovery that might happen. Okay, so financial sector has definitely changed in the recent past, and you will find that change also when the way they are dealing with the customer. That has been highlighted in the first paragraph. So this is just generic, not specifically important for the paragraph for the exam, but read that out. Nataraj sir, answering to your query, every company borrows uh, as a part of their normal process, because whatever their income is, their expense is slightly higher. If you look at Japan, it is, I think so, around 200% of the GDP is what they have borrowed. Okay, and it's a huge, every country. India, I think so, is around 60 or 70% of the GDP. So that is a normal process because your income is slightly lower than the expense because you have to spend on infrastructure company, infrastructure development, airports, hospital. So that is why this entire system keeps on running. So there's no problem as such. Read that paragraph. Now the main section starts over here. This is what you've already seen in level one. Okay, what this entire thing is important. Okay, what is the PD? PD means the ability or basically the probability of default. Okay, now there might be a scenario that for you might default briefly and you might quickly correct the situation. I told you about delinquency at the start. That has also been highlighted. When there is a small default, definitely or delinquency, you might pay the penalty or charges and you might again come back in line. So that is not a big risk for you. Okay. So basically, when we look at probability of default, it is at a broader level that the customer might not have the ability to pay. Okay. So that has been the likelihood that the borrower will default is not generally a greater risk because if there is a default, he might pay. When we hear the word bankruptcy, that's the final stage, and that is what the concern is. Now, PD along with loss given default. What is a loss given default? If there is a default, what is the amount that I would lose? It depends upon what is the recovery, what is the collateral available, is the bond or loan that I've given, is it secured or not? So all of these factors will come into picture. It simply means what is the amount I will be able to recover. Okay, and if the default is brief, the customer suffers no loss because again you will come back. But if the default is permanent, which is nothing but bankruptcy, then you know that okay, then there is going to be some loss because the recovery will not be 100%, definitely, right? Both LGD and PD, this is also an important part, are expressed in terms of percentage. We have seen this in level one. Okay, the same concept is again going to come into the third chapter. Okay, so both PD and LGD are expressed as a percentage. Okay. Exposure at default, if it's a normal loan, exposure is what the loan balance amount is. If I've given a loan of $100, it will not go up. It will always go down because the customer might repay a certain amount. And this exposure at default can also be expressed as a percentage. But normally in the historical level one also, we talked about it in terms of dollar amount. Okay. In terms of dollar amount. It can also be percentage of the notional amount because in the OTC agreement, okay, if you look at swaps, okay, the amount that you have to pay on a each payment date is basically some 1 or 2% of the entire notional amount, right? And that too, it is netted and paid. So that is the exposure at default. And what exactly is the expected loss calculation? It's basically the multiplication of all three of them. Okay, now till this section we have not there's no difference of what we have seen in level one. Okay, so I'm just taking a quick pause for and asking you to read, okay, in the content. Girish, answering to your point, notional principle will primarily come in the OTC derivative agreements. Okay, for example, if it's a CDS contract, there's a notional principle. If it's a swap contract, there's a notional principle, right? Forward rate agreement, there's a notional principle. So it has been referred from that perspective. In terms of a retail loan, it's the percentage, how much percentage is outstanding of the loan. You can think about that. Right, Girish? Done? Let us go towards the fourth factor, which we have not explicitly highlighted or read, okay, in level one, which is also written over here. Expected loss for a given time horizon. Okay, mark this also a star. Okay, why are we talking about this? See, whenever you are calculating a PD or LGD, It is for a particular time horizon. Because if the time horizon increases, the PD should ideally go up. Because if I'm giving a loan to somebody for 1 day, the risk is low. But if I'm giving a loan to somebody for 10 years, the risk is higher. The probability of default is going to be higher because you don't know what all things can happen in the next 10 years. So the longer the time maturity, the longer the risk. Okay. So it should increase the probability of default. That is fair, logical. Okay. Loss given default and exposure at default can change over a period of time. Because say, for example, an asset which you have right now as a collateral, the value is very low, but in the future, the value might increase in time. Okay. For example, crypto. Initially, when it was launched, nobody was looking at it, but now everybody is looking at it. The value is shooted. Okay. So the LGD and the exposure at default changes with time. Okay. If you're into the OTC agreement, the exposure can change fast. In the credit risk book, we're going to be looking at counterparty risk series chapters. In that, the OTC agreement is talked in more detail. Okay. LGD is nothing but how much loss I would face. This would depend upon what is the loan that has been taken, okay, or the credit line that has been. Credit line means bank gives credit line to his customer that, okay, suppose if I've given a credit line of 1 crore rupees and if the customer can come back and withdraw maximum till 1 crore rupees without any questions being asked. Okay, that is primarily happening. Okay, so read that paragraph and also mark that paragraph as star. All good. Okay, so basically there are 4 parameters that has been highlighted in this section. Now this calculation is very simple. It is not, I don't expect this direct calculation to come, okay, so for the exam, because it is basically, if you look at this example, what they're saying that, okay, it is estimated that the probability of default is 4%, the loss given default is 80%, and the exposure is now around 75% of the total loan amount or total exposure, 75% of the notional principal or to loan amount. So when you multiply, you get 2.4%. Nothing extraordinary over here. This is a very basic, simple calculation. Kindly check the question. Okay. Right. And all of these numbers, for example, the loss given default, a lot of companies, what they have is they have an historical background. That means they've been lending for so many years. So on the basis of this historical understanding, they can understand, they can calculate what can be the PD or what can be the LGD. So if a bank in India right now they are looking at, they would primarily run models to assess that. They have their own model, Sagar. They run own model for PD and the LGD. Nataraj sir, answering to your query, primarily in the question, they would, instead of what change they can do is, they, instead of giving loss given default, they would give a recovery rate separately. It is, you have to calculate the loss given default and then move towards the expected loss. Collateral generally will not, they will not include it in the collateral this section. Because if the collateral is there, then there are a lot of other questions involved into it. What is the risk of the collateral? What is the volatility of the pricing of the collateral? That will also come into picture. So generally they try to avoid it. It is assumed that whatever collateral they are giving, that value of the collateral is fixed generally. Right, sir? Sagar, I've answered your query. There's no fixed metrics as such to identify. They have their own internal model. There might be industry specific models used, but I have not heard the names for any particular concern. Moving towards the failure versus insolvency, this is an important part. Mark it as double star for your exam. Okay, for your exam. Okay, so what they're trying to tell you is that when a bank is fail or insolvent, these two are different terms. Okay, and they've given you an example also in the initial part. So if you look at this till this section, I want everybody to read this part. Okay, bank is insolvent. That means they might not have sufficient amount of liquidity to run the bank. Okay, but they might have the asset available. which they cannot sell in the market because the market is not available. But liquidity is an issue. So what bank or regulators they would do is, if they identify a particular smaller bank is not performing well, they would ask SBI in India, for example, or Bank of Baroda to merge it. Okay, so they will often get merged with a healthier institution. Okay, the reason they are being merged because it is very easy and convenient to merge it into a bigger bank rather than making a default. Because if it becomes a failure, bank failure means complete end. Okay, then it ultimately has an impact to everybody who's associated with the bank, especially the depositors. Okay, and it also hits the trust of the people with on the banking community or on the banking structure. So it is better to merge those insolvent banks, okay, which do not have the ability to remain liquid. Okay, they can merge it to the major healthier bank. That is the crux of the point. All good in the first four lines. Now read this section. This is not important, but this is only for reading. What they're trying to tell you is that only 50 banks failed between 2008, 1 and 8. Okay, half of which failed in 2008. So during a particular period of time, there was a huge concentration of banks failing. Okay, definitely the financial crisis had an impact. Okay, and a lot of these banks, they lost their capital, they lost their trust for the bank, the banking community, and we are also talking about approximately 2% of the bank failed between 2009 and 10, and after that only 1.5%, 1.2%. This is just number to help you identify that government was trying to reduce the failure by pumping in taxpayers' money or combining it with some other bigger bank in that way. Okay, so read this last four lines. Taking you further, now this paragraph tells you that what regulators at a global level, what they have been doing is they've been identifying globally systematic important banks. And they have done identification of 29 banks where they have to keep extra capital. Apart from the Basel requirement, they have to keep additional amount of money. In India, you have domestically systematic important banks like HDFC, State Bank of India, Bank of Baroda. These are domestically important. If they fail, Indian economy would go down. Okay, so that is the reason they are asked to, they are required to hold additional capital. Okay, so that if there is a default, they have some certain amount of money available to protect. Okay, so read this paragraph. This is also going to get repeated in the further chapters of credit risk. All good. Let us move toward the this part. This is important. Okay, mark this as star. Read the line properly. Bank can remain insolvent without failing as long as it has a source of liquidity. Now, where the source of liquidity will come? Ideally, it is the regulator, or ideally, it is the central bank which pumps in liquidity, lender of the last resort, to make sure that the bank sustain for a certain period of time, so that we can merge it to a healthier bank and we can take a decision. Okay, so bank failure has been quite less in the history because they know the impact to the economy because of the failure. So they would try to find some alternative solution to this. And now also post crisis, there has been a scenario of too big to fail. Okay, so a lot of US regulators are also they have tried to create a structured plan. If there is a bank which is too big to fail, how will we liquidate it in a structured way so that it does not impact the economy? That has also come out after the 2007-8 crisis. Now, why are we so much concerned about banks only as a part of the financial institution? Because they are highly leveraged, because they take a lot of money from the market, which is basically through depositors and all, and they use it to give money or lending to the other part. Okay, if the bank defaults, depositors will lose money, and also the institution which gives loan to a lot of companies, that will also get reduced. So that can have an impact on the economy. Okay, so that has basically been highlighted. The last three lines. Okay, this is basically what they're trying to tell you is that there are a lot of banks which are very good, triple A rated, double A rated. Okay, very historically very good bank. There are also banks which are default rating. So banks fall in various categories. Okay, some of the banks are doing very good, some of the banks are not doing good. So that has been highlighted in the last three lines. So kindly read till this section and give me a quick confirmation on chat. Let us go towards the quick questions. Stacy is trying to focus the potential loss of her loan. Firm has met to the mid-sized company. She determined that there will be a 70% loss if the borrower does not perform the financial obligation. Now, what is this? This is very easy, right? 70% loss if it defaults. This is a loss given default. Very simple and straightforward. Bank of the plain states have been struggling with poor asset quality for some time. The bank lends to farming operations that have been struggled. Okay. Bank regulators have recently required that the bank write off some of its loan, which has entirely wiped out the capital of the bank. However, the bank still has some liquidity. Read this section. This is important. So the capital is not gone. The capital is straight away gone, but there's some liquidity it can use, including from its correspondent bank and the Federal Reserve. The bank is currently in what state? Is it failed? No, right? It is not failed. It is insolvent, but it has liquidity available. So answer is A. Answer is A. Right? So this is where we complete the chapter.